All right, now we're doing. We're starting the recording. I'm going to share my screen here. All right, you should be looking at my screen here. Welcome to today's class. We're on October 8th. The material that we're using in this class for today is listed right here. And here are next week's modules. I'm going to go through the outline of lecture notes, week 7. So let's pull that up. Actually, I did that already. Here it is. And what we're going to do here today is go through several things. We'll do the asset tracking. We will do our homework and midterm, give the key for the homework and midterm. We will also then do a discussion on structure of interest rates, and that's what we're going to be talking about for the next couple of weeks. So go through that and give some background for that and do a couple examples. So that's the outline for today. So you got any questions about that outline? And I've got to get let me see if I can get my chat box up here. Well, my chat boxes. Well, I'll worry about that later. All right, so this week, the stock market went up a little bit from 3298 to 3348. It went up 1.51%. And what were some of the reasons that you put down for the impacts on the market this time? There it is. There's my chat. Huh. There it is. All right. Yes, Trump testing positive for COVID. Yes, that was mentioned. Thanks, Zach. That added uncertainty to the market. Anything else that people wanted to are mentioned here in their write-up? But yeah, Trump testing positive for COVID. I'm not sure what day that came out. Is that a Friday, Thursday last week? I'm not sure. I am not sure. But anyway, let me, I chose to put an article on here on bond yields rise in a volatile trading day. That happens to be here. I am for the next while going to, so I put 2 articles on here. Bond yields rise in volatile trading day, and stock investors can take refuge from election-related volatility. Those are 2 articles I found, but this one, I'm going to, for the next couple weeks, find the ones dealing with the bond market. And almost invariably, if you go to, you will find some discussion of the 10-year Treasury note. All right, so, and this article discusses that 10-year Treasury note. And again, the 10-year Treasury note happens to be pretty, it is the interest rate, if you look, or rate yield that if anybody's following, it's going to be that one. It's sort of the bellwether curve. It's out there long enough to be longer term. It's pretty highly traded, so it's a pretty good number to look at. And this, and one of the things that I want to point out here is we're talking about virtually no changes in the 10-year Treasury note rate here recently. If you look at our asset tracking, and now I'm looking at our lecture notes here, it was 0.71 at the beginning, went down to 0.64, 0.74, 0.72. Last week it was 0.70. And all of those are really low yields. And I just want to give you a feel for how low that is. Let me go over here, and I'm going to go into Fred. Fred is, I'm doing a search for Fred 10-year Treasury rates. And I'll tell you what, Fred is the St. Louis Fed's website. That's why I do Fred. Let me get this larger. So this is the 10-year Treasury note, and I'm going to do the max. All right, this shows the yields on the 10-year Treasury note. We're back here. The first one is well, they're in the 60s, March, probably January 1962. You can see at that point in time is 4%. We went up here, kept going up, and we reached nominal highs here. That was our high, 15.84%, and that was back in September 1981. I know most of you, none of you were alive then. I remember those interest rates. Those were extremely high interest rates. They were high because of high levels of inflation in the United States. Now, one of the things that you're going to note here is that 10-year yields have been coming down. Boom, boom, boom. I mean, since this 1980s, they have been coming down. In 28, and I'm going to stop here in 2008. 2008 was when we had our pretty large financial crisis. The shaded areas here represent recessions or depressions when the economy is contracting. You can see that we hit what we thought were low 10-year note rates back then. Kept going down, 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 down. Sort of wobbled around here. We were 3.15% 2 years ago. Now I want you to see something here. So this is December 2019. We were 1.92. So still way above where we're at now. And this is COVID-19. All right, we've seen these 10-year rates come down a lot because of Fed actions. So if you're buying bonds now, actually any sort of interest rate, you're looking at very low interest rates, lower than anything I've seen in my lifetime and lower than anything we've seen since at least 1900. I don't know what happened before 1900. But you can see here we're at very low levels. And so when they're bouncing around here, you know, we're getting next to no changes here, but we're at extremely low levels. And just I want to keep that in mind as we're looking forward through time here. Some of the items that were mentioned as news was one of the ones Zach mentioned. Trump tested positive for COVID-19. But the whole inflation or election situation, I guess, is adding uncertainty. Last week, and I'm going to point this out this November when we get close to the jobs week, which is the first week of November. We actually saw less jobs created than was expected, and then there was uncertainty about the election. So that were the things that were mentioned there. And again, I am going to focus for the next while as we're looking at this on what's happening to bond yields. And my guess is not much, but I'm going to put some more information about bond yields. Again, if you think about it, you're following the market, the stock market, the equities, the Treasury notes, and what's happening in the Treasury note gives you an aggregate feel for what's happening in the overall yield market. All right, I'm going to stop there with that. If we have any questions about asset tracking, make those available to me now. And if not, we are going to move on to our homework that you just completed and then asset tracking question for this coming week. Seeing no questions, I'm going to stop sharing my screen and Enrique, take it away.
Yeah, I think it's need you allow me. It's disabled some.
All right. Let me more. Huh. I wonder how that happened. There you go. You should have control.
Yeah, there you go. So for talking about, can you guys see my screen? Is it?
Yeah, I can
Yep.
see.
Yep. Okay. And pull up the chat if someone says something. What is that? I don't know. Okay. So yeah, I can't see the chat for. Oh yeah, there you go. Chat over here. So before going over the homework, I'll just go over real quick through the midterm. So the midterm, if you didn't see that yet, is graded. You should be able to see your grade on Compass. I think that you are able like to see the on the multiple part, multiple question part. You should be able to see which question do you get. Did you get a what?
Shit.
Okay. So you should be able to see which questions you got right or wrong, I think. If not, let me know because it's supposed to be there. Okay. So I'm gonna go quickly here over the multiple part and the open-ended questions. What we were expecting. So with that table, you should be able to calculate those geo-means and standard deviations, Sharpe ratios, alpha and beta. We're gonna talk about it and significance of those. Question one, we ask you to analyze geo-mean and standard deviation. Right, so straightforward. I won't go over the calculation, but if you have doubts, just let me know and we can go over. Sharpe ratio, same thing, right? The excess returns over the risk-free asset adjusted by its risk. So you should be able to get those. Alpha and beta for this fund, you should get it from the CAPM regression, right? It was the CAPM alpha, so you should be able to get the intercept and the coefficient here, so 0.0072 and 1.18. For the market, the things we said that treat that as the market. So there's no regression here, but because it's the market, you should be able to know that beta equal 1 and alpha equals 0 under the CAPM, right? So you should be able to find that or to field that. Alpha and beta for effect, same thing here. Just look at the regression results, intercept and coefficient. Going over here, if there was statistically significant at 10%, so we gave you the interval of confidence, you would look at the p-value, and if it's greater than 10%, not significant, lower it is. So first one here is not, and the second is significant at that level. Then we asked you, what was the process used to create, how the process creating a mutual fund basically, and an ETF would differ. And most of you guys were on the right track here. So basically just stating that for mutual fund, you first sell the share of the fund and then you buy the assets. And ETFs is going to be the opposite. You first buy assets and then sell shares. Yeah, so this was the difference on the creation of those funds. Okay, some of you guys said like different differences, but we were looking at the creation process here. Okay, these things here, Sharpe ratio, the interpretation of that. So for each unit of risk produces X excess return over the risk-free asset. Just you have to have higher expected returns under the CAPM pricing model. So remember the CAPM pricing model, the only thing that can affect returns or expected returns actually, it will be the beta, right? The volatility compared to the market's volatility. So the greater the beta, the greater the expected return, okay? So just because it has higher beta, it's should deliver higher returns under the CAPM pricing model. Okay. Then you gave you a regression here on the three-factor model, and those two questions here about the two coefficients here, we decided to take that off the exam because it was miswritten. So there was two right answers over here, and it caused confusion. So we apologize for that, but we are not considering those. Okay, so we took it out from the exam. Okay. Then alpha for FTAC under the three-factor model. So should be able to look at the intercept here. Same thing here, and the interpretation is very similar to the CAPM. The only difference is after adjusting by its investment style, right? It produces excess returns because it's positive. There was two A and C here. So, oh, that was beta. Okay, this is misreading, but you guys got it right on the actual exam, I hope. Then this is for regarding alpha. Yeah, this should be beta. So alpha, excess returns, and beta can mean here the risk that it will bring to the market portfolio, and also you should be able to interpret that. So yeah, this is slightly off for me here, but at the exam I remember that it was right. This question 15 here, why would they be different? So first it was an open-ended question, but then you probably saw multiple choices. I should be able to find that the difference is that the three-factor model takes into account other risk factors, right? Size and book to market ratio, or growth and value, right? So it accounts for different risk factors, and that's why alpha, it's different, might be different under one and the other, right? Some general questions here. We gave you two assets, and we asked you, like, looking at those two, which one will have the greatest difference between its mean or regular average and its geo mean. So you should be like, I don't know if you guys remember, I hope so. The greater the standard deviation, the greater the volatility. If it goes to negative at some point, so this is what causes the geo mean difference to the mean to be larger. Okay, so just by looking at the standard deviation, they're higher than the return, so you get negative returns eventually, and this will cause the difference between the arithmetic and the geometric mean. Okay. What best describes market efficiency? All information available is already reflected on its asset prices. Then we gave you the 4 funds here characteristics. Remember that box, right? The Morningstar box. If you have income, then blend and growth being the most riskier one. And on the other y-axis, you have small, mid, and large cap. As you go towards small, you have more risk and supposedly more returns as well. So I'm jumping here maybe to question 20. You should be able to rank those from highest to lowest risk based on, so characteristics here 2 and 3, right? This is what we're looking for question 20. Question 18, which of the funds are likely to have lower costs? So lower costs are associated with being index funds, right? It doesn't have anything related to income or large or small. It's just a matter of indexing or being active managed, right? If you're active managing a fund, you're probably going to charge more for that, and it's higher to have higher costs or higher fees, right? So A and C would be the lowest. Then which fund would be likely to be held by people that believe in market efficient? So if you believe the markets are efficient, if you strictly believe in that, you believe that you can't beat the market. So there's no point of investing on a fund that's actively managed that is trying to beat the market. So you would go on the index funds, keep your costs low and index it, because you cannot beat the market, right? So yeah, A and C again. Finally, we gave you this EV frontier of a lot of assets, right? You have here the efficiency frontier and the max Sharpe ratio and the minimum volatility. Question 21 here, why is the EV frontier bold towards to the left? And the reason for that is because the correlation between assets are in between are lower than 0 or than 1, sorry, right? But they are not also -1. I could have put it here, but just lower than 1. It's what causes to both to the left, right? If there was only these risky assets to pick, so there is no risk-free asset, why would an individual have the minimum volatility portfolio? So just because he's very risk averse, right? Now, if you have a risk-free asset, then the portfolio that he will pick is always the max Sharpe ratio, right? So he would hold the max Sharpe ratio here on the risky assets, and it will combine with this risk-free asset, right? So if you have the risk-free asset as a choice, it's always the max Sharpe ratio. And then the combination between this max Sharpe ratio allocation and the risk-free is according to the risk preferences. Finally, question 24, true or false? So we gave you 2 assets here. If you look here at the EV, it's SLV and VBK. SLV over here, VBK over here. Why would an asset, or actually the question is, VBK has a greater Sharpe ratio. You could have calculated that to make that, to realize that it's true, and thus it will always be preferred over SLV in any portfolio, right? So the question here, the answer here, it's not true, it's false, because you don't know your portfolio. So if you have a portfolio that is super correlated with this asset, maybe this other asset will bring you a better diversification. You bring greater diversification, and it might be chosen. Okay, so you cannot say for sure that just by looking at Sharpe ratio that it will always be preferred, right? So this always word that change, or that you have to be careful with. Okay. Questions on the multiple part? I'm gonna move forward. If you do so, just type on the chat box or stop me here. All right, so I'm going a little bit fast because I think it's just a review, and I'm just making sure that you guys don't have any doubt on that. For the open-ended questions, I uploaded the file there. First question here, we asked you to draw the EV frontier, and you could have pasted the graph, draw like I did here, like very, very pretty draw. But there are some elements that they need to be there, right? So to get full credit for that, we were looking for properly named axis. So we know this is return, this is standard deviation, return risk, that's fine as well, volatility, that's fine, but it has to be, you have to name them, right? Name the assets here, so you know which one is it, and properly ranked here according to returns and standard deviation. The EV frontier had to be somehow bowed to the left, and what I mean by somehow, it's I mean that, let me draw that real quick. So if you did it something like that, that's fine. If you did this, it's fine. That is fine as well. Now, what could not have happened, what we were not expecting is a straight line, right? Because if it's a straight line between those assets, it means the correlation is equal 1, and you know the correlation is 0.65. And something else that could not have happened is it touching the y-axis, because that will mean a correlation, a negative, perfectly correlated situation here. So -1, the correlation. With that, you can make a risk-free portfolio, and you can, right? So Anything in yellow will be fine. Now, red here, that was not what we were looking for, okay? And again, if you use the graph on homework 2, perfect. If you hand draw that, fine. So you could have done that. For question 2, we asked you, considering that you have those 2 risky assets, which combination of those you would use to combine with the risk-free asset? Again, this doesn't matter what's the risk preference of your client, you or whoever you are working with on the EV frontier. If you have a risk-free asset, you will always pick the max Sharpe ratio, right? The most efficient portfolio that go all the way that way to mix with the risk-free asset. So it will be somewhere here. A lot of you guys did that calculation. Awesome. Okay. And put the exact calculation. What will be the max Sharpe ratio? Maybe you look at the homework 2 graph. Maybe you calculated it with, solver. That's fine. Awesome. But if you have just told us that you would use the max Sharpe ratio combination here, that's what we were looking for. So some of you wrote that you would use just asset 2 because asset 2 has a higher Sharpe ratio than asset 1. But by doing that, you are disconsidering the risk efficiency that you get by putting those together, okay? So indeed, asset 2 has a greater Sharpe ratio than 1, but when you put those 2 together, you can produce an even higher Sharpe ratio, okay? So the max Sharpe ratio should be the portfolio that you are gonna mix with the risk-free asset, okay? Now for question 3, we consider almost all of them. If you said here that you have any combination 51 to 49, like 51% into the risky assets and 49% into the risk-free asset, all the way over to 100% on the risky asset, because this is a risk-loving client. So he likes risk, and so you're taking more risk, but you are at the same time making sure that he is with an efficient portfolio, right? So this was what we're looking for here. Any combination that lean towards the max Sharpe ratio, even 100% of the max Sharpe ratio, it's acceptable, okay? Now, yeah, this is a better draw. Now for question 4, you guys came up with a lot of good assumptions. The main ones that we were looking for was just returns, standard deviations, correlations, or if you think about it, the inputs in your model will be held. But there are tons of others, and you guys thought like really good assumptions, right? So like the risk preference of the individual will not change. Individual would indeed listen what I'm gonna be doing. He doesn't have other investments. That's awesome as well, because if he does have other investments, you might want to take that into account to create a new portfolio for him, right? So there are a lot of the main ones that we were looking for is the return, standard deviation, and correlation will be held, right? Because maybe you looked at historical data or not, but you are assuming that this is going to happen, and that therefore this is the allocation that you are proposing. If that changes, your allocation will change, right? So yeah, this is what we're looking for the open-ended questions. I think overall you guys did pretty good. I think the average was on the both parts was, I think 89 or 90. So you guys did pretty well. But if you have any doubt or you want to go over your exam or something, just shoot us an email and we can set up a meeting and talk about it, okay? I'm sorry, I already closed it, but I'm assuming you guys are okay with that, right? Can someone just confirm yes, or you guys still listen to me or not? Or can I move forward to the homework? Thank you. Okay, so homework 5. Now we talked a lot about equities mostly, right? Now we are moving to fixed income. We're talking now about bonds, right? Question 1. So we gave you a bond here with 6-month maturity, $1,000 par, and 1.5 yield to maturity, and ask you to calculate the bond price, cash flows, and but we're looking at those three last ones: bond price, calculate duration, and modified duration. So this is just an intermediate way for you to get those. Okay. So a couple of things, a lot of emails I got and very good questions. Just make clear here. So up to 1 year bond, usually they are zero coupon bonds. Okay. So for question 1, there's a no coupon rate indeed, right? So what you get from the cash flows is just the par value at maturity. Okay. So what I'm doing here, so since yield is 1.5%, remember for bonds, everything works in semi-annual periods. So I just divide that by 2 to get my yield to maturity for semi-annual periods or 6 months. Then there's just 2 cash flows here, right? The maturity is 6 months from now. What we'll have at that time, I will have my par value, my $1,000 back. Okay, but now the $1,000 that I'm gonna be getting back 6 months from now actually has a different value for $100,000 in today's value, right? So what we do is we discount that to present value here using the discounted cash flow, and it's some of those discounted cash flows will be equal to your bond price. Okay, so if you look here at the cash flow, it's okay if you left 0 here on the very first one, but if you think on what happened is on year 0 right now, I paid $992 now for a future cash flow of 1,000. And by doing that, I am getting this yield. Remember this rate of return, you can think, at maturity. Okay, so this is what we're doing. We have a future cash flow, which is the par, and we have the yield to maturity, and we are solving for present value. This is basically what we're doing. Okay, and this is the bond price. This is what you pay now. Okay, now for the market duration, what you would do is just multiply the period times the discounted cash flow to get it. And finally, to get it, you would sum the market duration here, numerator, and divide that by the bond price. It's equal to 1, right? Gary will be talking more about it, but on average, you'll make payments every 1 here period. And we set here semi-annual, so it's 1. If you wanted to express that in annual terms, you would just divide that by 2. Okay. Modified duration, you would just get the market duration and divide by 1 plus the yield to maturity. In this case, semi-annual, because we're talking about semi-annual market duration, and you get 0.99 here. Okay. Question 2. We gave you, I hope you guys all saw the announcement. We forgot to include the coupon rate here. So we have the same bond, but now it has 5 years of maturity, and it has a coupon rate of 3%. The intuition and how we get the calculation here and the things are the same, okay? But now the difference is we have more periods, right? And we have the coupon rate. Coupon rate, so think of that as payments along the periods. So we're saying every period you're gonna get this coupon rate times the par value, right? But now be careful. The coupon rate, if we don't say anything, and for this first homework, that's okay if because we didn't explicitly said. But if you don't say anything, that's an annual coupon rate. And so for the cash flows here from year 1 to 9, that you're gonna be getting the coupon rate, you're gonna be doing the par times the coupon rate divided by 2, right? Because those are 6 month periods. They're not years, right? So with that, you're gonna be getting $15 all the way year 1 through year 9, or sorry, period 1 through period 9. On the very last period, what you're gonna have is the cash flow, so the 15, the coupon rate, but also because it's at the maturity, you're gonna be having the par. Remember the future cash flow that you are paying for. So now we have our future, our projected cash flows. What we can do, discount them all to present value. So this is, we did this discount factor in discounted cash flow, but if you would do the net present value formula, you should be able to get the same result, okay? So this is what we're doing here. We are discounting those future cash flows to present value, and the sum of this discounted future cash flows is equal here to the bond price, what you're paying right now. So bonds, essentially, you are paying right now for what's the future cash flows that you're gonna be getting, right? So you should be able to get 1072. That's okay, first line if you let everything zero, but think about what really happened. Year zero, you paid $1,072 for that bond, received 15, 15, 15, and on the very last end, you received 1,015 back, right? And if you run the returns on that, the internal rate of return on that, that will be equal to the year to maturity, okay? Your internal rate of return. For the macro duration here, you would use same thing here, period times discounted cash flow, and you go that all the way down. Thing, just drag, okay? I know there's some big ugly numbers, but you don't have to do it by hand, which is good. And then for the macro duration, is just sum all those macro iterations numerator. Remember of the formula, you have this 1C, 2C divided by, yeah, you have 1C, 2C, 3C, and so forth. And then you divide that by the bond price you found. And this is the macro iteration here, okay? Now, we didn't say explicitly here, so that's okay if you did differently, but this is semi-annual, right? And think about it. This is because you have here semi-annual periods, right? So just sum them and divide by the bond price. If you want to state that in annual terms, you just divide that by 2, right? So simply as that. And for the modified duration, again, there was no here. So if you did it both ways, that's okay. Semi-annual here is just divide the macro duration by 1 plus the year to maturity. Now, if you want to express this modified duration annual or yearly here, what would you do is you're gonna use the yearly macro duration and the yearly yield to maturity. Okay, so just be consistent what if you're doing semi-annual or annual periods. Okay, so yeah, you should be able to do that, and I encourage you to go over that later on. I think it's a very good exercise to see what would change. Oh, sorry, what would change if I change my yield to maturity, right? 5, for instance, if I take no coupon rate. So this is really helpful for you to understanding what kind of instruments are those, right? What are you paying for? So are you paying for those future cash flows, right? So the thing, what would change, right, is the price that you're paying right now for that, and it depends on the future cash flows and how you're discounting that or the to maturity. So it's a really good exercise. I think it was really helpful for me, at least, to figure out what's the structure and what can change here, the return on bonds. Okay. Finally, question 3 is just the inverse. Now you have cash flows and you are solving for the yield to maturity. Okay, so it's the opposite here. You know that you pay $985 right now. You know that you got 7.5 and so forth, and at the very end, this is a $1,000 par bond. You can tell. So you can just run the internal rate of return formula, which what it does, if you look at the bond price formula, it's solving for the Y, okay? So you would find this, but remember that you have to do it multiplied by 2 because you have semi-annual periods, right? So what I found here just by regular doing the IRR formula, it's the semi-annual yield to maturity. That's why, remember, you have to multiply by 2 to get the yearly yield to maturity, okay? Again, we didn't say explicitly here, yearly. If you didn't do that right now, it's fine. But if you don't say anything, assume that this is an annual one. Okay, so this is what always you're going to be seeing yield to maturity on websites and such. It's going to be yearly. Okay, so try to get used to that. Okay, and I guess this is it. If you guys have any questions on homework or something else related? Okay, I think then Gary, you can have the screen back.
All right. All right, and I am going to start sharing my screen again. Okay. So, all right, we got the homework and the asset tracking done. Now I'm going to cover several topics as we're moving forward here. And the first one is just a little background on the structure of interest rates. So we're going to be talking about the structure of interest rates for the next several weeks. And one of the things that we know about interest rates is that they exhibit known tendencies. So, and again, let me just go through those. And there's 4 things that we can say if we're looking at a yield to a bond. These 4 things will cause a yield to bond vary from one to the next. And this overhead shows probably the 2 most important ones. The first, if you're looking at the horizontal axis, is the time to maturity. And you can think about the time to maturity being differentiated as you go, but by another dimension, risk. And here at the bottom is no risk, which we generally define as U.S. Treasuries. So when we think about U.S. Treasuries, we're thinking that they have no risk in the sense that they will not be defaulted on. So if you think about U.S. Treasuries, you don't think that that those U.S. Treasuries are going to get defaulted on anytime ever, actually. Generally speaking, sovereign governments do not default or do not make the change payments on their debt. As we move up here, the risk, we have different levels of risk for a bond. And I'm denoting those here as AAA, AA, triple B, double B, B, and then a category called junk here. And as you're moving, and those are actually credit ratings. So there are organizations that provide credit ratings on bonds. And as you go from AAA to AA, the risk of default is going up. As a result, as you move this direction, your yields are going up. As you increase the risk, you increase the yield. All right, the other thing you'd notice here is if we increase the yield to the time to maturity from 3 months to 6 months to 12 months, 3 years to 5 years, in general, we increase the yield. And let me just give you an example of that from today. I'm going to show here, I'm in Wall Street Journal's website, market data, And I am going to go to the bond page here. And here, over on our right, we see the list of bonds here: 1 month bill, 3 month bill, 6 month bill, all the way up to a 30-year bond. All right. These, as we're going up here from 1 month to 30-year bond, we're pushing out the maturity further and further and further. Just a couple of other notes here. This 1 month bond has a 0% coupon, 3 month 0, 6 months 0, 1 year bill 0. In general, you don't. In general, and again, we're talking coupons now. That's the inferred yield, or this is the coupon tells you what payments are, and when we're less than a year, there's generally no coupon payments. We hit 2 years, it's 0.125, and it goes up to 1.37 here at the high end. All right, this is coupon, but what we're really looking at is yield here. I want to look at is yield, and these range from 0.087 1 month, 0.089, 0.12. And you'll note here, they just keep going up. All right, our yields are increasing as we are pushing out the maturity of the bond. So right now, our 30-year bond has a 1.56 yield to maturity on it. Again, this is what varies from time to time based on what's happening at the market. And just to give you, again, here's the 10-year note. Let me just do it for the last year. Here's the rate, the yields on those 10-year notes for the last year. You can see here we're bouncing along here between 1.5 and 2, and then COVID-19 hit, and then we're down here. All right, so this is where we're at currently. And again, those yield maturities are market driven. Again, they increase as you increase the time to maturity. And that's typically what you think will happen. All right, and that, by the way, is what the relationship here is what we're going to be talking about this week in our modules. All right, so that's yield to maturity. And again, that's one dimension that you think of impacts bonds. There are 4. First is duration, which we just talked about, and I use interchangeably duration and time to maturity. All right. And if you think about it, the duration and the time to maturity are measuring the same thing. Duration is the average time you're going to get payments. Time to maturity is when it matures, and those two are highly related. The higher the duration, the higher the yields, typically. All right. The second thing that matters to yields is the credit quality. So if you're looking here, we can go here and get higher yields. We can go higher yield maturities. The other dimension is to go up, okay? And by up, I mean lower the credit quality. So if we lower it from treasuries to AAA to AA to A, our yield is going to increase. All right? Lower quality leads to higher yields, which makes sense. The more risk you take, the more yield you will want to have. Now, you'll notice here these 2 items are working in tandem. If you have a 3-year note, it's going to have higher yield than a 3-month note typically. And if you have a AA note, it's going to have a higher yield than a 3-month note. But how these vary within here, you don't know. Just saying it's going up in risk does not necessarily mean it's going up in yield, because you could also be impacting the time to maturity. So both of those, you got to keep in mind that both of those work together. The third characteristic is inflation protection. And the inflation protection, you can get that in Treasury inflation protection products, tips. And those are, and I'm going to just show you what those are. Let's see if I can find one really quickly. I'm going to go to the Treasury quote page. There's our Treasury notes. Oops, I went too far. I'm sorry, I need to go to the key interest. There's my tips. There's my tips. So here's my Treasury inflation protection. You can see the maturity here, 2021, 2020, so on and so forth. You can see these have negative yields, and we'll talk about that when we get there. But these yields, if you have inflation protection, you generally have lower yields. You're taking one of the risk away. And we'll talk about inflation protection when we get there. And then finally, there's tax deferment. And again, municipal bonds you don't pay taxes, federal and sometimes state, on municipal bonds. And having that tax deferment will tend to lower yields. It's an advantage. So you can pay more for the bond because it has that advantage. So those are the four things you typically think of that impact bond prices, okay? And again, this week, we are going to focus on this time to maturity or duration with treasuries. So if you're going here, you're going to see structure of interest rates. These are all in our item dealing with treasuries and looking at those concepts in that context. All right, so there's there. I want to move on here, and here's our yield to maturity equation, which you're all going to know and love. And just again to reiterate, if we have a price of bond, coupon payments, we can calculate the yield to maturity. If I give you the yield to maturity, you can tell me what the price of bond is. Here's our Macaulay duration. Again, that gives us our measure of how long in the future a bond will make a payment. All right, I'm going to do a little question here. And by the way, this comes from an old exam. So we're going to do a couple of these questions here. And so this was on an old exam. I told you we have a treasury due in 6 months. You're going to get paid $1,000 in 6 months. There's no coupon, no payment except $1,000 in 6 months. So we got a bill here. So the first question is, will this bill's price ever be above $1,000? And what do you think the answer to that question is? Will we buy a bill for more than $1,000? All right. Think about that a little bit. And would you ever buy a bill that you're going to get $1,000 in 6 months for more than $1,000? And you're right, Jake. No, you wouldn't. All right. And if you did, you would have a negative interest rate. All right. Which kind of blows your mind. And I would agree with you. If you answered that, you would have gotten full credit for this exam. However, let me just give you a however. Occasionally, in very turbulent markets, rates go negative. And here's what's going on. Let's say you're an institutional investor and you have $1 billion to invest someplace and you want to get it out of stocks because you do not know where it's going to go and you're afraid of where it's going to go. You need to park $1 billion someplace. Often the only place that you can park it is in T-bills. And because in those turbulent markets, there's such a high demand for T-bills, you occasionally get to the point where they are negative. All right? So if you see negative interest rates, you're pretty sure that something bad is going on. We had negative interest rates on T-bills or negative rates on T-bills in 2008 during the financial crisis, during the initial stages of the financial crisis. All right, the next question is, what would be the purchase price if the desired yield is 4% annually? And let me just set this up here. This is we're doing a lot of this, but I'm going to set up the equation now. All right, there's my equation editor. Let me write it right here. All right, I'm going to get $1,000 in 6 months. Oops, I'm going to make this equation this way. There we go. So I'm going to get $1,000 in 6 months, and I want to know what the purchase price of that is if my desired yield is 4%. So what I'm going to do is discount that back. My desired yield, 4%. And my answer here is, if you do the math of that, you'll get the answer. Hey, Enrique, could you do the math of that?
Yeah, just a sec.
All right, just kind of tell me what that answer is. So, and all we're doing here is coming up with the yield to maturity or the purchase price by discounting at that point in time.
I got 980.39.
All right, so that would be the answer. All right, so then question 3 is, what is the yield to maturity if we purchase a bond at 990? And now you're just working the opposite way. And let me insert another equation here. So we're paying oops. All right. And we're going to get $1,000 in the future. And now we're just going to solve for all right, so now it's a matter of solving for y in that equation. And you're going to find out that y is something, but you're going to work around the terms and find for y. And that would be your answer here, whatever Y turns out to be is your desired yield to maturity. Again, if we're looking at these types of instruments, we give the price, we can find the yield to maturity, and vice versa. If you give the yield to maturity, I can find the price. These strip bonds or treasury strips are pretty straightforward to come up with the answer to those, and you can solve for Y there and come up with the answer. So there you go. All right. So any questions or comments here? All right. Now I want to do one other thing. We're going to our next example here. And this, let me just tell you, I put this on our website. Let me go to the website. You will see this bond in class example. I'm going to bring that down. Here we are. Let me make this big. When we used this last week, but I'm going to use it again. All right. All right. So we did this last week. We have a Treasury note that is due in 4 years. It has a 2% coupon rate. Its yield to maturity is 1.5%. Its bond price is $10.1934. And we found that out by discounting all our cash flows. So here's our cash flow, 10, 10. So that's $1,000 par. We said we have a 2% coupon rate. So 1,000 times 0.02 divided by 2 comes up with our coupon payments and 1,010 at the bottom. And then we're discounting by our 0.015 to come up with our discount factor. Take it times the discount cash flow, and there's our bond price. All right, let me put that bond price right here. All right, 10,019.34. Now I did exactly the same bond over here, except that it's now 5 years in length. Okay. And I, for sake of a example, just said it's the same yield to maturity, which would generally not be the case, right? Because this bond has 5 years longer in length, you would expect it to have a higher yield to maturity. So let me copy this down here, and I'm going to illustrate something though here today. All right. This one is going to have a higher Macaulay duration than this one. And I'll just do that calculation real quick. Let's do the Macaulay duration calculation. So this will be the discounted cash flow times period. That's their numerator. And here's our Macaulay duration. This is Macaulay duration. M-A-C. That's close. All right. So that has a Macaulay duration of 7.73, which means that on average, its cash flows are 7.73 periods in the future. Let's do the same thing over here. I'm going to put this over here, multiply this times this. All right. And now equals sum. All right, it's 9.54. All right, and that there is nothing surprising by that, right? So a 10-year or a 5-year, 10 semi-annual periods is going to have a longer duration than a 4-year. Okay, good. Now here is one of the things why duration is important. Longer term bonds, higher duration, are going to be more sensitive to interest rate changes. The reason why that is straightforward. We're discounting those cash flows by more. And I'm just going to give an example here. I'm going to raise that yield to maturity from 0.15 to 0.25, 2.5% in both cases, and you're going to see that this bond price on this 4-year note changes less than a 5-year note. All right, so let's just do that. 0.025. Bond price is 0.981. Oops. Let me copy it as a value. And this is 976. So 976. Now let me just give the percent change here. So this one went down 3%, right? So it just took this ending value at 2.5 minus 1.5, subtracted 1, it went down 3.7%. This one went down 4.6%. All right. Now, longer duration bonds will always be more sensitive to yield changes. All right. So that is part of the, all right, and now think about this, step back a little bit. One, why that is because we're discounting a cash flow further in the future, so discount factor has more of an impact on it. All right. It also helps to explain why longer duration bonds have higher yields. All right. The normal yield curve is sloping up because you have to deal with the fact that yields can change over that period, and longer maturity bonds are going to be more sensitive to those changes. Okay. So that is a part of the reason why yield maturities are higher on longer run bonds. All right, let me give you one other scenario here. If I want to get a higher yield on a bond fund, I will move to a higher duration. That also means, and this is finance, I go to a higher duration, higher yield, I'm bearing more risk. The higher risk comes from the fact that I have locked in funds for a longer period of time. All right, one final comment here. Let's say you are concerned that yields are going to go up in the future. You would tend to move to lowered, shorter duration bonds because they're going to be less impacted. Let's say the opposite. You're concerned that yields are going to come down in the future. You would go to longer duration bonds. Okay. So think about that, and we'll revisit that in future sessions. All right, I am going to put that down there. All right, if we have no questions, I am done here today. And Ricky, I don't think we're up.
I don't think so, yeah.
All right, you have a homework. Same routine as before. Homework is due Tuesdays, as well as asset tracking. So get those turned in, and you all have a good week, and we will talk to you next week. Same time, same station. So talk to you then. All right, I'm going to end this. So start saving.